Hi, welcome back. In this lecture, we will go through part 1 of the capital structure ratios, where we will walk through the debt to equity ratio. On this slide, we will calculate the total debt to equity ratio for Amazon. So what is the debt to equity ratio and why is it important? Well, the debt to equity ratio is used to evaluate a company's financial leverage. This is a key metric because it reflects how much a company is financing its operations through debt, as opposed to its own funds. A key point is that a higher leverage ratio usually means higher risk for the company and its investors. As an example, a high debt to equity ratio can indicate that a company has been aggressive in financing its own growth with debt. So how is this calculated? Well, the total debt to equity ratio is calculated as the company's total debt divided by its shareholders' equity. For Amazon, we can see that it has total debt of around $75.4 billion. This includes the long-term lease liabilities, long-term debt, and other long-term liabilities on its books. Next, we find its shareholders' equity amount of around $62.1 billion. Once we take these amounts, we come up with a ratio of around 121.46. So what is this telling us? Well, this tells us that as compared to its equity, Amazon has approximately 1.2 times its debt. In other words, in order to attain its substantial growth over the last several years, Amazon has incurred debt to finance its growth. On this slide, we will now calculate the debt to equity ratio for Walmart. Again, using the same formula, we'll start with total debt. And here we can see there's multiple components to Walmart's total debt amount. We come up with a value of around $72.4 billion, which includes its short-term borrowings of around $0.6 billion, long-term debt due within 1 year of around $5.4 billion, operating lease obligations due within 1 year of around $1.8 billion, and finance lease obligations due within 1 year of around $0.5 billion. We've also included the long-term debt of $43.7 billion, long-term operating lease obligations of $16.2 billion, and long-term finance lease obligations of $4.3 billion. That gives us our total of $72.4 billion. And then we find its equity on its books of around $74.7 billion for fiscal 2020. Once we calculate this ratio, we come up with 97.01. So what does this mean, and how does it compare to Amazon? Well, this tells us that Walmart's total debt is slightly below its equity amount. When we compare this to Amazon, we can see that Walmart has a slightly lower debt to equity ratio. In other words, based on this metric, Walmart is not as highly levered as Amazon. Welcome back. In this lecture, we will go through part 2 of the capital structure ratios, where we will walk through the interest coverage ratio. On this slide, we will calculate the interest coverage ratio for Amazon. So what is the interest coverage ratio and why is it important? Well, the interest coverage ratio is used to see how well a company can pay the interest on its outstanding debt. It measures how many times a company can cover its current interest payment with its own earnings. In other words, it tells us how easily a company can pay the interest on its debt obligations. The main point here is that a higher interest coverage ratio is better, although this ratio will vary depending on the industry and sector that the company operates in. So how is this ratio calculated? Interest coverage is calculated as the company's annual operating income, or earnings before interest and taxes, EBIT in this case, divided by the interest expense during the year. So to calculate EBIT, we'll first start with operating income of $14.5 billion, and we'll add other income of $0.2 billion. And that gives us $14.7 billion of earnings before interest and taxes. We then locate the interest expense during the year of $1.6 billion. Taking these amounts, we come up with an interest coverage ratio of 9.2 times. So what does this mean? Well, this tells us that Amazon is able to cover its interest expense around 9.2 times based on its EBIT amount. In other words, Amazon generates a healthy earnings amount, which is more than sufficient to cover the interest on its debt obligations. Now, moving on to Walmart. To calculate this, we'll use the same formula, and we'll start with calculating EBIT, or earnings before interest and taxes. Here, we locate its operating income of $20.6 billion, and then we'll add the other gains amount of around $1.9 billion. This gives us an EBIT amount of $22.5 billion. We then calculate its interest expense, which includes two components. First, we have the interest on its debt obligations of $2.3 billion. And we also add interest on its finance, capital lease, and financing obligations of around $0.3 billion. This comes up to total interest expense during the year of $2.6 billion. When we calculate the ratio, we come up with an interest coverage ratio of around 8.7 times for our Walmart. So what does this mean and how does it compare? Well, this tells us that Walmart is able to cover its interest expense around 8.7 times based on its earnings. When we compare Walmart to Amazon, we can see that Amazon can cover the interest on its debt obligations more times than Walmart. In other words, Amazon is more easily able to cover its interest expense as compared to Walmart. Hi, we will now go through the scorecard for the capital structure ratios for Amazon and Walmart. First, we calculated the total debt to equity ratio for Amazon, which came up to around 121.46. And that was higher than what we calculated for Walmart at 97.01. So in this case, Walmart has the advantage because it's not as highly levered or leveraged as Amazon.